Okay, in this video, I'm going to talk about the purchase of inventory. So it's the operating cycle and it's the transactions between the merchandiser and the manufacturer, us being the merchandiser. So we are Walmart and we're purchasing Barbie dolls and TVs from Mattel and Sony. So when I think about the true cost of my inventory, it's really made up of four elements. Okay. The first element is just the raw invoice price. And so we're going to talk about that briefly. I think we've already talked about the purchase of inventory in indirect ways when we were talking about supplies. It looks very similar. Then we're going to want to talk about discounts. We have instances when um, the manufacturing companies or our vendors offer us discounts, purchase discounts. And so we'll talk about that. Then there will be instances when we receive the goods, it lands on our doorstep, and we need to return some of it because for whatever reason we no longer need it. Either it's damaged or we purchased too much or we bought the wrong color. So we're going to have to account for the return of some of our inventory. And then finally, a lot of times we have to incur the cost of inventory, right? So we have to pay for shipping. How do we deal with that? And so the combination of these four elements is going to be the absolute determination of inventory. So we purchased in this example $235,800 worth of invoice, had a gross price. We returned some of it. We got some discounts and then we paid for shipping. So the total cost of our inventory is $232,400. So let's keep it super simple and let's just go through the example where we purchase inventory. And I don't even know what we should buy, but we might as well have fun with stuff. Let's buy toilet paper and let's buy lots of toilet paper. Let's purchase like $100,000 worth of toilet paper that we're going to put in our stores and mark up in price and sell them hopefully for a profit. The journal entry to just buy toilet paper and we can buy on account, right? So we can have our vendors bill us at a later time. It's just going to be merchandise inventory. Merchandise inventory is an asset, and therefore, if I purchase $100,000 of merchandise inventory, it's going to be a debit to merchandise inventory. And then I will credit accounts payable. And I will credit accounts payable by 100,000. And we're good. That's the first step. Not so bad. Okay. First item that we can talk about, how about discounts? Discounts, a lot of times our vendors will provide us with discounts in order to motivate us to pay them as soon as possible, right? So cash is king. Everybody wants cash. The sooner that we, or the sooner that any of these companies can convert inventory to cash, the faster their operating cycle moves, the more their operating cycle moves, the more cash they get. So vendors will offer us discounts if we pay within a certain period of time. And so a lot of times we will see discounts, right? We'll get an invoice, and on the invoice, the discount will be, hey, we'll give you a 2% discount if you pay within 15 days. Otherwise, you have to pay the full amount within 30 days, right? So this isn't 2 divided by 15. It's instead a 2% discount if you pay within the discount period. And then if you don't pay within the discount period, right? So if you choose to pay something later than 15 days, you have to pay the full amount. And that full amount is due within 30 days. So I can have a scenario where we purchase inventory, and maybe I purchase the inventory on January 1st, and then on January 10th, we decide to make a payment because we want to take advantage of the discount. So on January 10th, the payment for my inventory would be, well, I'm definitely getting rid of accounts payable. I no longer am obligated to worry about that. Accounts payable is a liability, and if I'm lowering a liability, I debit that account. Now the cash that I pay, that's going to be, in this example, 98,000, right? Because we're paying within the discount period. If I'm paying on January 10th, that's a terrible looking 10, but if I'm paying on January 10th and the purchase was January 1st and my discount period was 15 days, then I'm paying within the discount period. And so the only cash that I'm sending is 98,000. And then the credit is going to be merch inventory, right? So I had, from the first example, an inventory account, and I debited that 100. And then after the second account, I am crediting that by 2,000. And so the true cost of my inventory is 98,000. Right? That's the cash that I paid. It's not the gross invoice price because I took advantage of a discount. Now, alternatively, for whatever reason, cash is important for us to hold on to. And so instead of paying on January 10th, what if we paid on January 20th? Like the greatest day known to man. Obviously, it's my birthday. You could send your gifts straight to the College of San Mateo, made out to Stephen Heath. Anyway, let's say we pay on January 20th. It's past the discount period. So the journal entry would literally just be accounts payable 100,000 and cash 100,000. Right? Because we're outside of the discount period and we can't take advantage of the discount period. All right. How about returns? I could purchase some inventory for $100,000. I have it in my T account right here, inventory from the previous example. I have $100,000. A bunch of this toilet paper comes in, and I open up a few boxes of toilet paper, and it is damaged or it's soggy and wet. It somehow didn't survive the trip or journey from the manufacturer to our doorstep, and I want to return some of it. Okay. I could choose to just send the inventory back. And if I do send the inventory back, I think and let's say that I'm going to return $5,000 worth of inventory. If I want to return $5,000 of inventory, I would, again, lower accounts payable by 5,000. And then I would lower merch inventory by 5,000. Not terribly complicated. And then if I received a discount and I paid within the discount is getting applied to the inventory that I'm obligated to pay. I'm not going to get a discount based on the original purchase of 100,000. Freight. Freight is the cost of shipping to get the toilet paper from the manufacturer to us, the merchandiser. And let's say that in an example, we purchase $100,000 of inventory, and we incur $500 in shipping costs. The shipping costs are going to be treated as an increase to our inventory. So shipping costs 500, merchandise inventory. And then it could be, we could just pay the shipping 500. And so just in summary, where were we? Yeah, right? Cost of inventory we talked about. Purchase discounts, we talked about those. Purchase returns, right? A return is when we physically send the product back. And then an allowance is the company doesn't really want the inventory back, but we're gonna get like another discount, right? So if we buy toilet paper and some of the rolls are pink, and we're like, hey, we didn't really want pink toilet paper, and they were like, hey, well, if you paid $2 a roll, we'll give you a 50-cent allowance per roll. Okay, keep the pink toilet paper, do what you want with it, and then we'll just charge you $1.50 for it rather than $2. That's an allowance, is when we get like a price reduction. And then we obviously dealt with the cost of transportation. What I would keep in mind is every time I'm dealing with the purchase side of the operating cycle, my merchandise inventory T account is getting hit in each one of those journal entries.